Now we'll turn to Asia and what's happening in the Asian theater. And one of the things that we wanted to talk about before we get into some of the data sets is just the surge in exports and imports, which has been a positive. And it's something that we were talking about where China was going to have to give up some of their export side, and not willingly, not like because they're trying to be good neighbors, but just because of shifts in supply chain. So we were expecting to see an increase in India, Indonesia, South Korea, all of these shifts up in terms of kind of where things are going to go. And Indonesia is just one of the examples where exports were expected to be at 12.23%, came in at 30.47%. Imports were supposed to be up 7%, came in up 26%. Again, we're starting to see that some of these moves, which are a positive when you consider how are things moving away from China and some of the other regions. And that's something that we're going to talk about throughout this segment when we consider what is happening in Asia and the shift in demand functions. So before we get further into that, let's look at China, because China continues to be obviously the topic of importance. But we want to look at what is happening with investment, emerging market investment grade, when we consider about the duration versus the ratings. So when we look at ratings in general and then the duration risk, you can see China IG, Russian IG, Kuwait. You're seeing some of this slippage into moving higher in general, and this is something that Damian Sassower, was something that he created. Those that heard his conversations, I recommend listening to it. He's obviously very sharp in terms of what's happening with the emerging market world. And you can see just where some of these spreads are and what their ratings are versus the duration, as well as the ratings. And with Russia, China kind of shifting. And now what we're starting to see with India starting to shift higher, Russia down here, you can see, again, all of this kind of shifting up as duration gets riskier. And obviously as the ratings are lower, you're going to start to see some of that increase. And again, this is the problem with what we've seen with China when we see the issues with their state-owned side, where their state-owned enterprises, as well as some of the international debt, which is another reason why they continue to purchase some of these U.S. Treasury holdings. Again, trying to get in front of inflation, trying to shore up balance sheets, pull down more dollars, get in more Treasury components, which again will help backstop some of their holdings in general. So then when we look at China credit impulses, this again speaks to what we continue to see, where the impulses are going to be negative, which just means that there's a move to pull some of this liquidity out of the market, really try to bring this down. And while that happens, you'll see pressure come into the commodity world because they're just not going to be buying the same amount on the industrial side. That doesn't speak to the same on the grain side, because people need to eat. They have food issues in terms of local, and that's why when we look at just the percentage points, there should be a net negative. Now, could they try to shake this because they don't like where GDP is going? Yes, this is just something that has been a target and continues to be talked up by very key figures within not only the CCP, but the PBOC. So then when we look at what is happening in China and in the Eurozone, this is where we keep looking at the duality of what is happening within Europe and what is happening within China. So the Eurozone manufacturing PMI, which has obviously surged to the highs, but then China official manufacturing PMI has started to slow down, and not slow in the sense of it's dropping below 50. It's a matter of just going sideways. And when we showed last week the charts of the correlation between European and Asian connections, this is where we think that you're going to start to see some of the pressure. So Pantheon is calling this. I think it makes sense. I agree with them based on just what the data that we've seen on the credit impulse side, that the Eurozone is going to see some of this slowdown on a PMI level, just as we see some of those slowdowns in China. Now, when we look at what the U.S. is doing, and this comes full circle to exports, imports from the Asian markets, Asian exporters are going to benefit from the U.S. stimulating the world. If you give a U.S. citizen money, they're going to go spend it. And a lot of those products are not made in America, but come from other countries. So because we've seen this shift away from China, away and adjustments to the supply chain, we've been saying that other nations outside of China, not to say China's not going to see a benefit, because they will, it's that other nations will see more of a benefit on a percentage point. And that's what we're seeing here with Vietnam, Indonesia, South Korea, India, Japan. And it's showing up now in the official data sets. Same with South Korea. South Korea is now surprise to the upside when we look at just so far through the first 20 days of April. We continue to see these moves up month over month, year over year, obviously with the base effect, but month over month sides is going to continue to be supportive. And this is where we see these benefits continue just in general so far. Now, when we look at Japan trade exports, this is where we always want to look at what is happening on the export versus import side. So exports came in strong. You can see just based on where they came in against estimates in general. Estimates were for an increase of 11.4%, came in at 16.1%. Imports expectation was for 4.7%. It came in at 5.7%. So, as we said last month, when we saw these huge imports and we didn't see the exports, we're like, no, that's going to make up. We're going to see a spike in exports, and now we've gotten that spike, and we're going to start to see some stabilization where we're going to be in a positive territory, because we will have more pull through. The imports slowed a little bit, still strong, still positive. So we're still going to have a strong move of exports. It's just not going to be, it's going to be at a bit more of a controlled pace. And the controlled pace is going to be driven on, well, what is PPI doing? What is inflation doing? How are costs going? So that's why when we turn to South Korea is something, very similar. We had an increase in just activity in general. So when we look at So when we look at South Korean PPI coming in above expectations, when we look at it coming in at 3.9%, that's happening, but we're still getting these positive moves in South Korean exports up 45.4% and imports coming in at 31.8%. So you're still getting this natural shift and natural adjustment as South Korea is pulling down. There's a lot of backlog in the system, especially on the tech side. So there is going to be pent-up demand that is going to continue to come from South Korea, Japan, and Taiwan specifically. Those three regions will continue to see growth, and the imports right here, just based on what we said last month when we saw these imports, it's going to continue to push through and show up in those export side. The problem is going to be how much of that PPI growth, how high can export prices go before we see a pullback? And right now, it's not enough. We're still going to see a lot of this pull through, and it's going to be a benefit to a lot of these Southeast Asian nations, Japan, South Korea in general. So then when we look at the valuation component on what are the currencies doing, the yuan continues to be the most overvalued among major currencies globally based on what Bloomberg and JP Morgan are saying against the effective rates. Now, this is something that we continue to believe in. We've been saying this nonstop, really, just because there continues to be a shift in how the market is perceiving China and debt and their movements in general. So there's going to be a decline in some of the moves. Now, the CAD obviously had a big move today after the Canadian bank made their announcements. That's something that I think should definitely be pared back in general. But when we look at India versus China, that's where we think there's going to be that swap. But obviously, COVID gets in the way. What is COVID going to do? What is the pressure going to be? But a lot of this overvalued component is also why they're running out there and trying to buy treasury bills. They're trying to do things to backstop some of these issues. As you know, now Australia just canceled their joining of the BRI. These are things that are going to become a bigger issue over time when we look at trade, when we look at shifts in supply chains and raw materials within the Asian theater. But when we look at this on a cumulative level on the Japanese side, so we had some positive news out of Japan, but where are the equities going to go? So where is that shift going to come from when you look at the underlying components? Because Bank of Japan is looking to try to do a little bit less after doing a lot. And you're starting to see foreigners essentially come back into some of these assets. But where are they coming into? Is it, when you look at Japan with some new issues with COVID, the Olympics are a little bit of an unknown. Will you start to see this temper and not so much go down, but just go sideways as there's a wait and see approach, given there's some benefits in terms of what the assets have done? When we look at convenience store sales in Japan, they're up year over year by 1.9%. When we look at industry index, it's slightly down versus expectations. Expectations were 0.5. They came in at 0.3, but again, last month was negative 1.7. So you're seeing some movement back, but that's why I think there's going to be kind of this holding pattern and this digestion period to understand where this is going to be in general. So then when you look at the Chinese property side, which we keep talking about on what happens in China, the residential selling price, the national property sales volume, all of this is starting to come down. And this is where they want to keep seeing some of the prices come and falling off to support more, again, take some of the liquidity out of the market, because this is where it's always been so frothy. This is where a lot of the politicians have gone to put money. And the view is trying to get some of this and again, shrink some of this excess capacity. And it's all coming at the same time as they come after Ant. They came after, obviously, Alibaba. So when the Chinese regulators want Ant to shrink its flagship, money market mutual fund, you can see the assets under management at $2 trillion. You see Ant and Tencent dominate the mobile payments market in China. So you're seeing a movement to adjust monopolies at the tech level, but also try to adjust what's happening at the real estate level. So that's when we're talking about Chinese growth and the expectations in the market and what's actually happening on the ground. There's going to be these pressures on what a growth is achievable, especially when we try to back out the base effect from last year and look at the month over month and how things continue to see pressure. And not only just, they're not even going flat, there's downside pressure to a lot of these components and initiatives. So then when we look at the yield on investment grade US dollar bonds of Chinese companies, we're seeing that risk aversion. So back to the chart that Damien showed, when you look at the yield to maturity, you're seeing these increases where people are essentially saying, look, there are problems out there. We know this. You have to compensate. And the compensation is coming in that yield to maturity. So as the yield to maturity goes up, it's going to cost more to borrow, which is why, and it just means that as it costs more to borrow, you're going to have to see prices go. You're going to see prices go up to compensate. But again, this is going to impact what does that growth profile look like in China, because it's going to be more expensive. It's going to hit into how much money is available to invest in CapEx, R&D. Because when we look at what China is saying, or the CCP is saying, that state-owned enterprises have to do more research and development. They have to drive more growth. But even they're seeing their prices of cost, their cost of borrowing going up. So again, that's going to put pressure on where do we go from here on a growth side. Then when we talk about pressure on growth, we can talk about India. This is looking at all commodities. So India wholesale price index, all commodities year over year have exploded, which when we look at where they are on a level playing field, you can see that obviously there's a base effect side, but there continues to be a pressure to the upside with all commodities going up. Now you have more lockdowns. Now you're going to have more disruptions in the supply chain, and commodities are continuing to go up just around them when you look at food and other. So the PPI side and the wholesale prices are not, based on just base effect, they're going to continue to go up. But month over month, they're going to continue to be strong as that inflation becomes a bigger part and a bigger issue within the country. So then when we look at the India exports, imports, this is what we want to talk about in general, because we did see this huge spike. Obviously, we have the base effect. But when we look at imports, imports continue to be a bigger driving force when we're looking at what is going to come going forward. And exports will continue to remain robust. The question now is, what is going to be the impact of COVID on some of these numbers? And we expect to see some damage to them over through April and even into May. And that's going to become a bigger issue for the developed world, as well as some of the emerging market side, because a lot of semi-finished products and cheaper goods for emerging markets come out of India. And with the issues involved, that's going to become a headwind in terms of just the general supply chain. Now, let's break this down a little bit differently. Manufacturers there, let's use Sealy for an example. They're having rolling shutdowns on the manufacturing side. So if you have 3 facilities, you're shutting 2 out of 3 down. So then you shut 2 down, you disinfect, you do what you can to make them safe, have 1 operational, then you bring 1 of them on, bring 1 down, clean that 1, and you trying to do that to maintain some semblance of manufacturing while you handle or deal with these COVID issues, which again is going to impact some of these numbers as we go through the remainder of not only April, but also into May. So then when we look at the India exports by dollar value, it's a better way to gauge kind of where we sit and take away some of that year over year. So clearly their India exports are up. They're still bringing in more money, which is a net benefit. And obviously prices have gone up, which is also going to account for the higher dollar value, but how much of that can continue to get pushed forward and pushed on. Now, when we talk about Russia, coming full circle to what we talked about with Crimea and Ukraine, as well as what has happened with their debt in general, the debt continues to trade at a significant premium in the market, just because, and by premium in terms of just a high yield, because there's still uncertainty as to what is going to happen within the geopolitical front, but also the realized prices that they're getting, as you can see, based on the private capital flow, continues to not be there. It's all being taken down by local banks, not foreign banks. And it's limited to the sanctions. It's limited to the issues with Eastern European nations that are kind of coming against Russia in different capacity. And then it's also the problem of where oil prices are and the ruble, because there's that friction in terms of what is that realized as they continue to face their own COVID issues, their own slowdowns in the industrial production front, which again is going to limit the amount of activity and keeping them in general of like, well, if I have to own someone, am I going to own Russia or am I going to own other? And that's where we start to see some of this friction and those the average USD ruble and just who is actually borrowing, because the current accounts is still positive, but private capital is coming out, FX interventions coming out, and we're starting to see some of those pressures. Then when we look at, again, the industrial production side, the survey was supposed to be negative 0.8%, came in at a positive 1.1%. A net positive in general. The problem is the rest of April has gotten a little bit slower. Now, it's not going to be a huge shift down, but it's going to be a more of a sideways, slightly negative move, which again is just showing a bit more of the pressure overall on just the underlying economy within Russia. And the reason why we talk about this when we're turning to Asia is because this is where Russia is going to have to deal with how much do they need India, how much can they manufacture and deal with China while they're trying to balance some of the risks and some of the issues that are happening with NATO. Can they get more from India while they deal with the NATO problems and the Eastern Front? What is going to happen with China? And that's where we're going to see some of this friction, and it's going to show up with what is going to happen with the industrial production and movements into those markets. Then when we look at foreign holdings of Chinese government bonds, you can see that they've slowed. So China is also having an issue of confidence where, that's what all of this is. Central banks, bonds, it's a confidence game. What is your confidence you're going to get paid back? And the less confidence you have, the higher the yield will be. And here you're starting to see that the saturation point of foreign holdings of Chinese government bonds are starting to pare back a bit. This is multiple things. One, it's value. Two, it's uncertainties on sanctions. Three, it's the uncertainty of just the general growth of China. And where do they fit in that inherent bubble basket and basket in general of bonds to own? So then when we turn to non-performing loans, this is where we start seeing more pressure on not only just Russia and India, but also China starting to eke out with non-performing loans continuing to go up. India and Russia are at the higher end of that, and obviously Nigeria. A lot of these countries on the emerging market side, it's going to weigh on their ability to borrow. It's going to weigh on their ability to do more, which again is going to limit the amount of growth that we continue to see within this region that's going to be generated by debt. And that's why what does fiscal policy, monetary policy look like as these overhangs will weigh on pricing? And then when we look at food, so food continues to be a big issue. When we look at, China's obviously increasing their record levels of corn, soybeans. They're shifting consumption from one to the other. And that's when we start to look at China, and this is the Clean Your Plate initiative, trying to adjust and try to see more of this food waste either go into consumption to individuals, or also go into feed for animals, which is why they're trying to take corn, soy meal, reduce the amount used for feed, increase some of the waste, and use wheat and trying to increase some of the protection for individuals, where India continues to be on that level as well. And there's also supply chain issues. It's difficult of getting something from the coast to the middle of the country, especially if you don't have strong roads, rail. So you can also have rot that happens from the coast to the middle of the country, which then results in more food waste at a much larger level. So these are some of those key issues that we want to address. Obviously, the U.S. is also a big problem. And actually, some industries have come up where, I don't know if you have this by you, but you can buy a box every week of goods that are good. They're safe. There's nothing wrong with them, but they're either the wrong color, the wrong shape, to go to the food market, and then you get it at a discount. So there are things being done that are creative, that are cheaper, fresh produce, to limit the amount in the U.S. And these are things that China has also tried to bring in terms of reducing the amount of food waste. So then when we think about food waste and some of these issues that have come up, we want to talk about Xi's move into, and he keeps talking about education. And this is where I always want to keep talking about what is the narrative on that education front. So the need for higher education, scientific knowledge, and outstanding talents to aid the development of the party and the country's undertakings is more urgent than ever. Colleges should share the country's wishes, worries, and needs, and focus on improving their abilities for fostering talents. Driving the party, trying to drive that party initiative, get the R&D, speaking to ways to something as simple as food waste, to technological innovation on AI, as we talked about earlier. But they still need to walk the party line. College teachers must strengthen their convictions, always stand with the party and the people, and consciously be firm believers and loyal practitioners of socialism with Chinese characteristics. China's restrictive information environment hinders innovation at the margin, but given the vast amount of resources aimed at fostering innovation, it's unwise to bet against Xi's technology push. So again, everything is being driven under party lines, trying to drive the education and grow the party from the base up, because they want these individuals, higher educated, innovators, to be part of a member of the party. But this is a friction point when you think of people want to own what they invented. They want to own the IP, and that's really not what happens here. So again, that's where we get these friction points. So then when we look at some of the Chinese pricing, some of the Chinese data points as they've come out over the last few weeks, When we look at industrial production, when we look at some of these components, and we talked about it on Friday, so this is just going to be a little bit of a rehash in general. So when we look at retail sales, decreased first in January because of the local COVID outbreak, and associated tightening measures only started to recover with month-over-month rates of 1.45% and 1.75% in February and March, which is much lower than the 4.5% pre-pandemic. This is becoming a bigger issue because when you look at the year-over-year numbers, they look good, especially when it compared to estimates. Retail sales look better than their estimate, but they're still not matching where they need to be in general, and that's where we start to see some of this friction as they look to take some of this capacity out. So then when we look at that China GDP constant price quarter over quarter, we're seeing where we are quarter over quarter, where we should be normally quarter over quarter, as January sees a little bit of that bump, and we're just not getting it. So when we look at the numbers, so first quarter 2021 GDP, 10.3% higher than that of the first quarter of 2019 for an average growth rate of 5% of the last 2 years. Where GDP growth was 6% in 2019, it was targeted to be around 6% in 2020, which again, you're still seeing some of this percentage points being missed to the downside. So we got a 2021 that was strong. You had some backlog. Again, supply versus demand. Supply coming in from the benefits of trade, demand coming down, which is again weighing on it. Some turn up in retail sales, but not all that strong. So then when we look at, just going forward in general, what Beijing considers high quality growth actually shrank substantially during the same period, which means that more than 100% and actually closer to 200% of last year's GDP growth was driven what they're trying to cut back on. Again, coming to property investment, fixed asset investment. Some of these things they're trying to bring down, but they incentivize it or saw that push higher in general, which is, again, not something that they want to see. So China added new debt equal to more than 33 percentage points of GDP in order to achieve the growth of 3% last year, which is why they're trying to pull that back, but they're not trying to even pull it back anymore. Now they're just trying to hold it flat. And that's going to put, again, more weight on or more pressure on growth as we go through 2021 and even into 2022. Which is why when we look at just where things sit, even on the year, you're seeing some of this slowdown. You're seeing some of the pare back. Obviously, you had the year-over-year benefits. But when we start to normalize this along seasonal levels, we're still not seeing the activity that China wants to see domestically as there are problems that continue to arise. Looking at the U.S., Europe, Southeast Asian nations, Australia. They need more from the locals, and just given the stress on the local right now from inflation, spending in general has just been under pressure and remains under pressure over the next few periods. So retail sales, now looking at this a little bit differently. So they were up on an annualized basis of 4.2% from the first quarter of 2019, which tells us that in the past 2 years, growth in retail sales has lagged growth in GDP by 2 percentage points, which had to be made up by debt and debt financing. So with confirmed in Q1 residential income, which jumped 13.7% year on year, annualized 4.6%, which means it has lagged GDP by just over 1 percentage point. In spite of what looks like strong numbers, the Chinese economy has in fact gone in the wrong direction and is expected to, in 2021, the rest of 21 should be a bit better on consumption, but what is the consumption going to be? Is it going to be abroad? Is it going to be domestic? And that's where we continue to see the pressure on the domestic side. Household incomes have gone up abroad. We talked about in the U.S., that's going to be a benefit for China, but not to the same degree because people are going elsewhere. Again, moving away, which is going to put more pressure because they're not able to replace that on the consumption side, but you're going to see the weight come in on the export side as imports continue to go up because they need more food and they need more stuff to try to because the imports will go up for local consumption and less for export, which is just going to become a bigger issue. But it's not because people are buying computers and high value things, but just general food and pricing and price increases going up is going to be weigh on them in general. So then when we look at the growth, so the view is then they're going to try to cut growth in investment in infrastructure and property so they can achieve GDP growth in that 6 to 7%. So not at the 8.5% that the market expects, closer to 6.6 to 7%, because you're going to see some of these things get cut as they, again, trying to pull that debt out of the system. Perhaps even a little higher, while keeping the debt to GDP ratio steady, which still requires adding new debt equal to roughly 20 percentage points of GDP, which, again, this is why even though we're staying flat, you're still going to see additions. So that's going to keep some of this growth in China in check when we look on the debt side, which is why we talk about credit impulses and all of these headwinds that will remain. So I know we talked about a lot. There's a lot of things happening and changing. If you have any questions, please let us know. We love the back and forth. Like, share, subscribe. Your support is appreciated, especially if you can share and get people interested in the stuff that we're trying to do. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.